Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into Alaska Air Group, ticker ALK, and the timing could not be more interesting. The airline reported earnings this morning, missed on EPS due to fuel costs, suspended full-year guidance, and yet the stock has a strong buy consensus from Wall Street. Why? Because in 2 days, something significant happens.
The Hawaiian Airlines reservations system migration. April 22nd is when Alaska and Hawaiian merge onto a single booking platform, the biggest operational integration milestone since the $1.9 billion acquisition closed last year. That event is what analysts are really pricing, not the Q1 loss.
Exactly. So today we're going to break down what the numbers actually say, what the integration thesis is worth, and whether the bears have a point about that $5.5 billion debt load. Let's get into it. Alaska Air Group is a Seattle-based airline holding company that operates Alaska Airlines and, now, Hawaiian Airlines. Founded in 1932, they fly to over 120 destinations across North America, Hawaii, and select international markets. The acquisition of Hawaiian closed in September 2024, making this the first full year of the combined carrier.
The business is classic airline economics. Passenger revenue makes up roughly 85 to 90% of the total, with cargo and loyalty program revenue filling the rest. The Atmos Rewards program, which unified Alaska's mileage plan with Hawaiian miles in 2025, is increasingly important as a customer retention engine.
And that's where the moat story lives. Alaska controls over 50% of capacity at Seattle-Tacoma, which is a fortress hub they've built for decades. Add in the fact that they control about 40% of mainland Hawaii traffic, and you start to understand why the acquisition made strategic sense.
The One World Alliance membership gives them global connection capabilities well above their size. And they're now part of a combined entity with nearly 30,000 employees and a fleet spanning Boeing 737s, Embraer Regionals, and Hawaiian's Airbus narrowbodies.
Revenue TTM sits at about $14.4 billion, market cap around $5 billion, and the stock is trading at roughly $43.54 today, down about 4% on the Q1 print. Lana, set the stage on why this is worth watching.
Alaska is trading at 0.35 times trailing sales, which is cheap even for an airline. The integration either unlocks massive synergies that justify owning it here, or it stumbles and the debt becomes a serious problem. That's the entire investment debate in one sentence.
Let's talk about the person steering this through that debate. Benito Minicucci has been CEO since March 2021, but his Alaska story goes back to 2004 when he joined as VP of Maintenance. He's a mechanical engineer from the Royal Military College of Canada, with 14 years in the Canadian Armed Forces before that.
Minicucci's background is operations through and through. He became COO in 2009 and built Alaska into one of the best on-time performers in the industry. When Alaska acquired Virgin America in 2016, he was tapped to run that integration as well, so he has direct experience with airline mergers before taking on Hawaiian.
His leadership style is what you'd call accountability with heart. He talks about holding people to performance numbers without making it personal. The quote I keep coming back to is this: "We have the responsibility, along with 23,000 people, to build on the fantastic legacy of this company." That sense of custodianship comes through in how he talks about the Hawaiian integration as a generational opportunity, not just a financial transaction.
The street generally respects him. He communicates clearly, doesn't overpromise, and has delivered on operational metrics consistently. The question investors are asking right now is whether his operational discipline translates to integration execution at this scale.
All right, let's dig into the financials. Lana, take it.
Starting with valuation. Alaska trades at 68 times trailing earnings, but that number is almost meaningless because TTM net income is only about $73 million on $14.4 billion in revenue. The more useful lens is price to sales at 0.35 times, which is near the low end of airline valuations. Price to book is 1.33 times. EV to EBITDA on a trailing basis is about 10.3 times. Market cap is $4.99 billion against enterprise value of around $10.5 billion, reflecting the significant debt.
And that debt is real. $5.96 billion in total debt, net debt of $5.5 billion, which is actually larger than the market cap itself. That's the bear case in a number.
On the income side for Q1 2026, revenue came in at $3.3 billion, up 5.2% from the prior year Q1. They beat the revenue estimate by about $5 million. Operating income was negative $279 million. Q1 is always the weakest quarter for airlines, the winter travel trough. Net income was negative $193 million, or negative $1.69 per share on a GAAP basis. The adjusted loss was $1.68, which missed consensus of negative $1.61 by 7 cents.
The culprit is fuel. Alaska burned jet fuel at $2.98 per gallon in Q1, up from $2.52 a year ago. And at 100 million gallons per month, every dollar per gallon is roughly $100 million in monthly cost impact. That's not a small number.
On margins, trailing gross margin looks high at 77%. Because of how airlines classify costs, most fuel and labor sit below the gross profit line in their reporting structure. What matters operationally is the operating margin at 1.5% TTM and net margin at 0.5%. Return on equity is 2.4%. These are thin numbers that illustrate why airlines are structurally difficult businesses.
Cash flow is where the story gets more nuanced. Q1 operating cash flow was $421 million, solid, but capital expenditure was $338 million, leaving free cash flow at $83 million for the quarter. On a trailing 12-month basis, though, FCF is negative $477 million because the prior 3 quarters included a heavy investment cycle in fleet modernization.
The balance sheet shows $451 million in cash, plus $1.3 billion in short-term investments, so total liquidity of roughly $1.8 billion. That's against $5.96 billion in long-term debt. The current ratio is 0.43. Airlines typically run below 1.0 because of the deferred revenue on unused tickets, but it's worth noting. Interest expense ran $76 million in Q1 alone, annualizing to over $300 million per year. That's real cash out the door before any synergies.
How do we score the overall financial health?
Under pressure, honestly. The debt load is heavy, FCF is negative on a trailing basis, and guidance has been suspended. But there's a clear path to improvement if the integration delivers. Q2 guidance points to positive unit revenue growth in the high single digits to 10% year over year, which would be a meaningful improvement. Overall, Alaska Air's financial health is under pressure. Elevated debt and negative trailing FCF require the integration to deliver to justify current prices.
So what does Wall Street make of all this?
The consensus is buy, with 9 buys, 3 holds, and 0 sells from 12 analysts. Average price target is around $60, which would be about 38% upside from today's $43.54. The range runs from Citigroup's $51 on the low end up to roughly $78 on the high end.
Citigroup cut to $51 back in March. That was their PT reduction, not their rating. Goldman Sachs is at $61, still a buy. UBS maintained a buy with a $54 target just last week. Evercore ISI and Barclays both maintaining outperform and overweight respectively. The street hasn't flinched on the rating, even after guidance was suspended.
That tells you something. When a company suspends guidance and analysts maintain buy ratings, it usually means they believe the narrative is intact. They're just pricing in near-term uncertainty. The Hawaiian integration milestone on April 22nd is the next proof point they're waiting on.
The Q1 print itself was not a disaster. Revenue beat by $5 million, EPS missed by 7 cents. Full-year guidance was suspended, but Q2 guidance is actually constructive. High single-digit to 10% unit revenue growth year over year. That's a recovery signal, not a distress signal.
Q4 2025 earnings in January were the outlier. EPS of 43 cents against an estimate of $1.11. That massive beat is what pushed many analysts to upgrade or maintain their ratings through the winter. The Q1 miss is the reality check, but it doesn't erase the Q4 signal.
All right, let's lay out both sides. Hudson goes first on the bull case. The Hawaiian Airlines acquisition is a generational strategic move. Alaska now controls roughly 40% of mainland Hawaii traffic and owns a Pacific hub at Honolulu that positions them for Asian expansion. That's a network asset that cannot be replicated.
The bear case starts with leverage. Net debt of $5.5 billion against a market cap of $5 billion is a 1-to-1 ratio, meaning any equity upside is fighting upstream against debt service. At $76 million in quarterly interest expense, you're burning over $300 million a year before any return to shareholders.
The synergy story is real and quantifiable. Management targets at least $500 million in annual run rate synergies by 2027, building toward $1 billion in incremental profit under the Alaska Accelerate plan. The April 22nd Single Reservation System Migration, PSS Go Live, is the operational backbone of all that. Once the combined loyalty program, pricing systems, and network optimization are running on one platform, the financial benefits follow.
But integration risk is real. The tech migration is the most complex thing Alaska has attempted. Mixed consumer reviews on the app, award booking friction, and account linking issues have surfaced since the acquisition. If the PSS Go Live creates widespread disruption, synergy timelines slip from 2027 into 2028 or beyond.
The loyalty program angle is underappreciated. Atmos Rewards, the unified brand launched in 2025, now includes flexible earning options, a Lyft partnership, Starlink Wi-Fi for elite members, and One World global connectivity. Co-brand credit card revenue from a unified program with 30 million members is a growing, high-margin stream that doesn't depend on fuel prices.
And the demand picture is not straightforward. Q2 unit revenue is guided higher, but the company just suspended full-year guidance. Tariff uncertainty affected 2025 bookings significantly. Management cited a $500 million revenue impact from booking slowdowns after tariff announcements. If trade policy continues to create macro headwinds, leisure travel demand could soften further in the second half of 2026.
Let's see how Alaska stacks up against its airline peers. On price to sales, Alaska is at 0.35 times, Delta is at about 0.45 times, United is around 0.35 times as well. Southwest is higher at roughly 0.62 times, reflecting a different cost structure and the premium investors pay for the low-cost model during its restructuring.
Delta is the premium benchmark here. SkyMiles Loyalty is arguably the most monetized loyalty program in aviation, and Delta's revenue per available seat mile leads the industry. Alaska is essentially valued like United, which has a much larger global network. If the synergies deliver, Alaska deserves a re-rating closer to Delta's multiple.
Southwest is interesting as a comparison because it's restructuring its own business model with assigned seating and re-die flights. Revenue growth is about 1.8% versus Alaska's 5.2% and Delta's 7%. Alaska is punching above Southwest in growth while trading at a discount on price to sales.
The peer chart tells a clear story. Alaska is not expensive relative to its airline peers. The discount to intrinsic value depends entirely on whether the integration delivers or disappoints.
Options market heading into earnings. What's the positioning look like?
Mildly bullish. The call-to-put ratio was running about 1.9 to 1 ahead of today's report, meaning calls outnumbered puts by nearly 2 to 1. Implied volatility was elevated at 71, which sits in roughly the 64th percentile of the 52-week range. Elevated but not extreme. Traders priced in a move and they got one.
Activity picked up around the April 17th date. There was a notable 12% surge in the stock that day ahead of earnings. Pre-earnings options flow leaned toward upside calls, suggesting the market was positioned for a positive reaction. The miss on EPS reversed some of that.
The elevated IV and the guidance suspension will likely keep options premiums elevated into Q2 earnings as well. Worth noting, if you're thinking about covered call strategies or protective puts, you're paying up for that protection right now.
Insider moves?
Not encouraging, but not alarming. In the past 6 months, there were 5 insider sales totaling roughly $3.2 million. CFO Shane Tackett sold 34,000 shares for about $1.9 million. CCO Andrew Harrison sold 20,000 shares for roughly $1.1 million. Zero insider purchases. The selling happened alongside the guidance suspension and fuel cost headwinds. Management is not buying their own stock at these levels.
That's a yellow flag, not a red flag. Executives sell for plenty of reasons: diversification, tax planning, scheduled programs. But no insider buying when the stock is down 34% from its 52-week high is a data point worth acknowledging. Top risks from here.
5 things to watch. First, the PSS migration on April 22nd. Any major consumer disruption gets amplified fast on social media and could delay synergy realization. Second, Q2 unit revenue versus single-digit guidance. That's the next earnings catalyst. Third, fuel prices. Every 10 cents per gallon is roughly $40 million in quarterly cost impact at current burn rates. Fourth, tariff and macro demand. The $500 million 2025 revenue impact from bookings slowdowns has not fully reversed. And fifth, the debt refinancing calendar, with rates still elevated, rolling over $6 billion in debt at higher coupons, could pressure free cash flow further.
Bottom line time, Lana, bring it home.
Alaska Air Group is a turnaround story wrapped in an integration story. The Q1 numbers confirm that near-term fuel and labor costs are suppressing earnings. The long-term thesis depends almost entirely on executing the Hawaiian integration to unlock $500 million in synergies and reposition as a Pacific-connected carrier. The Street believes it. 9 buys, 0 sells, $60 average target. The key metric is Q2 RASM. If unit revenue comes in at high single digits to 10% as guided, the integration is working. If it misses, the debt story takes over the narrative.
Alaska at 0.35 times sales with a buy consensus and 38% upside to the average analyst target. Integration risk is real, debt load is real, but the West Coast moat, the Atmos Rewards loyalty ecosystem, and the scale of the opportunity are also real. Keep an eye on April 22nd first, then Q2 earnings in July. We'll leave you with something the CEO said that I think captures exactly what's at stake here. We have the responsibility, along with 23,000 people, to build on the fantastic legacy of this company. That's Ben Minicucci, Alaska Airlines CEO. And for a company that's been flying since 1932, the Hawaiian chapter is either the next great chapter or the one that strained the balance sheet too hard. We'll see. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. And real quick, if this Alaska Air breakdown helped you see something you would have missed, we're doing this for every major earnings report. Hundreds of Russell 1000 deep dives, new episodes every week during earnings season. Subscribe and you'll get one of these for every stock on your watch list. Takes 2 seconds and you won't miss the next one.
Until then, I'm Lana Chen.
And I'm Hudson Thomas. We'll see you at the next one.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.